All right. Good morning, everybody. So we made it through FOMC. A lot of nothing, as we anticipated that it was going to be a lot of nothing. And then on the back side of that, we had some of the Mag 7 earnings. Now, this already looked like this before the earnings, but this is CTA positioning in the S&P. It looks the same way on the NASDAQ. So I didn't bring it over. The only difference is the NASDAQ has more of that shape too. And here's crude. Crude more closely aligns with CTA positioning. Gold. I was looking at this one yesterday. I was putting this in the chat. Should be able to go back and see the pictures. When CTAs got really ahead of their skis here, we had that move up. Then they got out, but gold really didn't sell off all that much. So they piled back in, but they didn't really get much of a run out of it. So then they got back out of it, but it didn't sell off again. Then they took a run in it, and gold had this nice move up. Now they've gotten out of it again, but we didn't sell off again. Now, I don't know. Nobody knows, right? We can't predict the future. But they're starting to get back in this again, right? And it could be that we can see another leg up in gold. Just like from back here, though, we don't know if them getting back in it is going to be a part of a run or if they get back in it and we just kind of stall out and we don't get much out of it. I say we don't get much, but I mean, gold moved 200 points from 26 to 28. So we got something out of it. But we didn't go from, 28 to 34 like we did back here. So keep your eye on gold because that really got my attention yesterday when I was looking back over this. Who knows, right? It's worth considering. What I wouldn't try to do is short gold. Now, copper, on the other hand, is taking a beat down and they're getting out of it. I know it's kind of hard to see because it's overlapping here a little bit, but we had the same thing back here. They jumped out and just smashed it to the downside, but it did stabilize, right? Copper's kind of got that $4 collar, especially, in the market backdrop with the SMRs. And I mean, everything needs copper, right? Everything needs copper. So, yeah, I'd keep an eye on it. It's going to stabilize at some point, and there'll be, especially since this is so violent, there will be a reflexive jerk back the other direction. It may be a big enough jerk that we get to name it. So, looking at the markets this morning, it was bullish exuberance with tech up the most, NASDAQ at 1.25%, Europe down 0.5%, and everything's scattered in between. Hong Kong basically flat, Japan up 0.25%, then the Dow and the S&P. Now, if you missed it, small caps way down here at 0.5%. We've been seeing the resurgence of the left for dead, low float penny stock meme resurgence, and that ended yesterday. Maybe it'll come back, right? It ebbs and flows, but for now, everything's about the crowded trade. We're going to get some jobs data today. This isn't the data, right? There's always this particular job data that you really want to pay attention to, non-farm payrolls. This isn't that. But any jobs data information we get you want to pay attention to. It goes to the heart of the Fed's dual mandate, and it is something that they pay particular attention to. Markets will respond to job numbers data. So if they miss, and these aren't out of line at all, but it's one thing you want to look at is the projections. Are they really far apart or not? And then when the numbers come in, how close are we? Be be mindful of the fact that we get revisions in this data all the time. So a lot of times you'll get the splash headline number, and then behind the scenes they'll do a rewrite and give some revisionist history. Once we're done with the core PCE, we're pretty much done for the day. There shouldn't be anything left in the afternoon session that can really mess with us. I mean, we got an auction at 11:30, but that's it. And it's the 4-week, so it's right up front. And rather than monitoring the 6 or 7 different upfront bonds, just look at something like the IRX. Just wrap it all up together. And of course, we got Secretary of Treasury Scott Bessent chipping his teeth this morning in an interview. Well, that number went right by, and it didn't even matter. All right. The call and the put wall didn't move, so I'm updating the indicator, but other than maybe the volatility trigger or the zero gamma, not much to mess with. But whatever. Go ahead and update it anyways. Doesn't hurt anything. So 63.32 cog line is where the put wall is. And now that we've made new highs yet again, we kind of need to keep this structure. Yesterday is a wide, expansive day, and that makes it a little bit tricky because we're outside of it. So we have this micro scoop pattern, and we have new higher highs and new higher lows forming today. Unless we run back down and break these lows of yesterday, which is not likely, right? Unless we get some really bad news today, then we're going to end up with these higher highs and higher lows. It's very likely we're going to continue this for the week, right? Finish off the month. And then August 1, we've got the tariff deadlines, we've got a new month. All the fun starts. We'll have DOOR, day one open range, DOOR, and we'll be able to define those metrics. But we're holding above every major moving average, and we've got new highs, new higher highs, and higher lows. This is a TRB that already played out because it wasn't a very big TRB on this time frame. On the 65-minute, it was certainly a better one. There's your TRB shape. So now what, right? One of the things that we can do is measure this range that we had and project that higher, while also defining, since we are underneath 100 again, is where that 786 is at. That's the level that we need to stay above, or we're going to go to half. And that's the level that we need to stay above, or we're going to go to 10. They're also cog lines. 6411 cog line is the half. And basically 6432 is the 4-period moving average. Yesterday's high, yesterday's close, those are also going to be in play. The high of yesterday is really close to the 786. There's no reason to overlap those two. They're just too close together. So I would lean on the 786 and then yesterday's close, then the half back. You could focus on yesterday's open, but I think true close would probably be better, right? Wherever that 10 a.m. candle was at, I'd use that instead. And then the 10 down below. I'm laying out these lower levels just because they are there to be laid out, not because I'm bearish in any way. We have to prove it if we're going to get bearish. And so far, we've kind of rolled over this morning after this move up, but we don't have any defining characteristics to be bearish. Looking at sectors and volume, news, headlines, any of that stuff, we're just trying to digest this move that was made. This isn't bearish. Right? We're maintaining around VWAP, so all good. The Globex low is where things are going to start to change, where that bias would begin to get reintroduced as something else. So we need to stay above 6432 cog line. And if we do that, then anything else is fair game. We can just sit here and chop for the rest of the day. 6450 is the mid. Is a level of concern, not the mid. I guess it's close enough. 6450 is the middle of that zone. And we need to keep it, or we're going to come back and check 32. All things being equal, let's go back out here to the daily for a minute. I know everybody wants to get all bared up because we've had these big runs and everything's extended, but we could go all the way down to 63.60 and we still wouldn't be bearish, right? In the big picture. That would just be us working on a range like we had this range back here, right? When we were in this range back here and we went from 63.40 down to 62.40, that wasn't bearish. That was just us just chilling in a range. So we could easily do that same thing again. We are sitting in this range and we could pull back to the lower edge of it and chop, and that would not have us shorting the broader market. So, just try to keep a little perspective and depth that, yeah, we've had a big move. And a lot of times in equities, when we get really big moves, it tends to mean revert. This isn't an equity. All right, so we hit the ADR half, and we did it relatively early last night, all things considered. And a good phrase that we use around here is, if you get to one side early enough in the day, you can get to the other side by the end of the day. And again, that would not be bearish. I know we're going down. We're looking at, like a 50-point drop. And sure, we would have some short trades to play, but we wouldn't get bearish in the broader market just because of this. This is just wave dynamics and how price moves. We did the same thing going to the downside, where we had these waves above and below the Linreg line. So we can easily do it again after this push up. It would not be bearish over the big picture. So I like this low 64.11 cog line. I like that as today's target if we get back inside of yesterday's range. At this point right now, there's no reason to think that we're going to go down there. We still have to break the midpoint of our own Globex range before we can begin to target something like that. Now, if we're still holding above this halfback and we get into the open, you could look at something like the SPX and see what the options prices are for buying a call somewhere around yesterday's mid, right? Which, if we measure the RTH of yesterday and just the mid of it, it's right on 6,400. But we're just talking, 0-day lottery trades. We're not talking about, getting some swing trades on or trying to get a broader market short. So the mid would be 63.66. And this is the SPX. It's yesterday. And of course, if we keep the elevated move that we have in the ES, the SPX will be opening somewhere up here, right? 64.50, 64.35, somewhere up there. And so we could target that 63.66 with some cheap calls, cheap puts perhaps, right? Maybe. Nothing really, quote, cheap when it comes to options on the SPX, but you get the idea. You could use XSP if you'd like. It is going to function the same way. You can't be assigned the options. They expire into cash or smoke. It's just not as liquid, right? It's really not as liquid. So break the mid of the Globex, get to the Globex low, close the gap, lower ADR, maybe 10 more points down into 6,400, and then turn around and we try to come back in again. We have no reason to continue the sell-off. And that's if we break the mid, which is a big if at this point. So we don't even know if we're going to be able to get that mid broken. Close enough. The if we do that range that we had, I grabbed the wrong line. 64.11, 64.10 cog line. It's today's ADR. So we got a really nice setup, all things considered. It's clear price action. It has definable characteristics. It's had a nice run. There's absolutely nothing wrong with our setup this morning. It'd be nice if we had, some cleaner flows in other things to go with it, but we'll take what we can get. We're back above the weekly floor pivot. That puts us back on a bullish footing. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That's bullish. Those two kind of cancel each other out. It's a wide channel, which implies that if we break out, the breakout doesn't stick. Well, we already did break out, and so far it's sticking. But we could define the idea that we're starting to roll over, and we've already started to break down below the trend line, and that, yeah, it's sticking for now, but if we break that mid, we're very likely going to come on back in again. It does look a little blow off topish, doesn't it? So, another rug pull like we had the other day wouldn't surprise. Little bull trap. We are resting on R1 after having expanded above it. There is something considered the R1S2. That would be having us focus on 6340. It's all the way down here. But it doesn't have to be all the way to the S2, right? There's a lot of dynamics that talk about an R1 to S1. They are much like my ADRs in that respect. So we would just focus on trading the ones, R1 to S1. And the fact that we broke out of the R1 and we're holding it right now, that again is what we need to keep. So whether you're using it as the mid of the Globex range or R1 or the options level of 6450, all three of those apply as a particular line in the sand, and it needs to hold it no matter which one of those characteristics we want to define. It just needs to hold that level or else. We don't really have a lot here. Kind of like what we had yesterday, a really tight value area with a clear point of control at 6411 cog line, and the structure that we talked about on last week's range is where we found some help. We were able to move through the shallow area really quick because that's generally what we do when it comes to shallow areas. We just move right through them, and we certainly did that. So no surprise, nothing showed up in any of this that, had us scratching our heads, and just nice to see price action doing what it's supposed to do, right? We see enough oddities from time to time that when it actually behaves, it's just kind of nice. The point of control now matches on the TPO and the volume profile. We've got at least another 3 days before this starts to tighten up. And at that point, it will look like this, which is much tighter than what we were just looking at. From 6350 up to 65, basically. This would be our new range, unless, of course, we expand higher and or come back down and break that 6350. And we have no reason to believe that we're going to challenge, even get near 6350. We shouldn't really get below, say, 6400 or 6392. If we do get below 6350, I'd focus on 6250. But we don't have any cause for that sort of consideration. We hit that VPOC yesterday, so it's done. And that's fine because we got a new VPOC and I want to steal the line for it. So we'll just grab it, move it over here. I keep mine on the round number, so mine won't line up exactly perfectly on the line a lot of times, but that's okay. You do you. Today it actually did. It's perfect right in the middle of the point of control, but that rarely happens because I'm not willing to put the ticks on there. I just leave it on the whole point. Still, we got a new VPOC 6417. If we begin working our way back down through our own Globex range and into yesterday's price, that's a level of interest where we could get a first touch play. First touch only owes you like 3 to 5 points. If you can get more, that's great. But it's what we want to aim for. And it's all a matter of allocation, right? If you think your trade's going to get 60 to 80 point move, you might as well, keep the contracts limited to 3 to 5 contracts and let it run. If you think you're going to get 3 to 5 points, yeah, it's time to size up a little bit, 18 to 20 contracts and get it done. It's just allocation. We still have the weekly expected move. We haven't hit either edge, and we are still within throwing distance at SPY. Hold up. Something didn't look right. There we go. We're still within throwing distance of Friday. So if we look at last Friday's price action and we look at where we are this morning, we're still within range of that. We haven't done anything. That's Monday's high and that's Wednesday's low. So far this week, we're like a hamster on a wheel, just getting in a lot of effort, but not really getting any results. If we do continue to move to the upside, 65.11 cog line is in play. It's the upper edge of the weekly expected move. 63.44 to the downside. And our distance from the 10-day moving average, we're not overextended. We're not overbought. We did not move too far too fast, and it does not owe us any sort of pullback or mean reversion at all. Now, I've been working with AI on this. Each one of these histogram bars or Schwab bars is how far the moving average moved on a day-to-day basis, right? Because every day the moving averages that we use, they get updated and they have traveled. And depending on how far away price is from that moving average, it will move farther, faster. So when we're really close to it on a day-to-day basis, it doesn't move much. And when we're really far away from it, then it moves quickly because it's trying to catch up with us. And that's because we're looking at a quick moving average like a 10 period. If I changed that to something like a 50 or a 200, this would all look completely different, right? But I did go looking around at different moving averages. There's a lot. There's some interesting stuff on the 200, but that's for another day. The main thing right now is that the average move per day for the 10-day moving average is around 11 points, and that's declining because it was 12 the other day when we were looking at it. The average is declining, but we can see over the last few days that it's been increasing, right? And that's because price ran fast and the 10 is trying to get caught up with us. So it's making an acceleration, trying to get caught up with us. But this is not showing anything extreme. That's the takeaway, right? If I zoom out, you can see these really high peaks when things did get wild, when we moved so fast that we ended up mean reverting back in the other direction. It was after things had gotten extreme and the 10 was trying to keep up and it couldn't, and price had to mean revert, go back and get it. We're nowhere near that stage at this point. So all good. I haven't got the code yet where I can flip this over to a weekly the way that I flipped this to a weekly, but I'm working on it. We'll get there one step at a time. So looking at the weekly, we're still close to 4% away from the 10-week moving average. It's a bit much, but we've seen further. We've gone farther and still managed to keep our calm. So not expecting this to turn into a wash at this point. The thing you want to focus on is the idea that we can go back really fast, right? We can be nearly 4% away, and then the next day we can be 1% away, that we can get a 4.5% drop fast. And we're talking about how close we got to the 10-week. Now, the 10-week, it's supposed to only move once a week, but depending on your broker, it's constantly shifting early. It's I can't remember the words that they use, but it's like a shadow update. So they didn't use the word shadow, though. They used a much more fancy market term. But the thing is, the 10-week is moving, even though the week isn't done yet. And there are early projections of where it's going to be next, depending on how far we've moved away from it. The cause for alarm is how fast we can go back towards the 10-week. And of course, it's going to continue to be moving up towards us as we're moving down towards that. So we can have a down day of 1%, and the 10 had an up day of, say, 1%, and then combined, we just had a 2% move on this indicator. Everything looks good so far, except that we are a bit far away from the 10-week. We're maintaining that, and we are trying to just calmly get back to the 10 without any extreme drops. That's what we want to focus on. We don't want to get back up into that 4.25% or 4.5%, and we don't want big radical drops. So if we do start to move down today, just kind of check where that 10-week is. We shouldn't see it today, right? We shouldn't get that sort of a move in a single day. From a money rotation standpoint, if we're going to get back into the hyperscalers, which is what they're yelling about all over on like Bloomberg and everything else today, is that sure that it's a crowded trade, but it's, the only thing to get in and blah, 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 and everybody's piling back into it. That it's likely we're going to see staples take a hit, building materials, industrials, and that the ones on top, the risk on sectors, along with utilities, because that ties into AI and data centers, those should continue to do really well. But finance kind of lagging at this point over a 5-day period is down more than 0.5%. And consumer discretionary is basically flat. Doesn't look that healthy when you start counting how many sectors have the Linreg pointing to the downside. But whatever. All right, Mag 7 down volume is down 7%. I know it's a double negative, but it's actually positive. China XXX is down close to 2.75. China again and again. Banks are down. Energy, financials. We need financials, and it's not good to see it down. It's one of the 3 risk-on sectors, so we can rally without it, but it'll be a sloppy, kind of choppy, forced buying event, grinding higher, and it would be better if we had financials. So keep your eye on financials today, because it can be the flip script to the whole day. I like to use KRE instead of XLF, simply because XLF is too vague. It has, insurance companies in it, trading firms, and it's just too broad. So I use KRE, keep my eye on the banks, and then I've got MAGs here because it works in pre-market, but you could use NY Fang once we get into the open. We want these two both going up. So, if we open up at 9:30 and the S&P and the Nasdaq's trying to run, keep your eye on the financials. If they're flat or sideways, we can run. If they start to really heavily sell off, we're going to have a hard time running with those falling. The Mag 7 up volume is up 7.25%. Over a 5-day period, that equates to being up 1.25%. So it was down quite a bit. The Mag 7 group is up 3.5%. Growth and communications up with tech, Bitcoin. We have everything we need to run, except we don't have finance. So as long as finance just sits sideways, we're good. We can take this day and rip it. But if we lose finance and it really starts to sell off, it's gonna I think it's gonna foul the spark plugs, so to speak. We had a lot of other indications that China was down, but KWEB is up. Now, China, broadly speaking, is like the collective market of China. KWEB is more of their internet ETF. So it's not quite, quote, tech, but it's Chinese tech companies, internet. And that ties in with like Baba, Baidu, those guys. So just like how the US can have chips up or tech up, while staples and commodities and healthcare and everything else can be down. That's kind of what's happening in China today. Quantum's up with uranium. Yeah, this could be a really good face-ripping rally day. Wouldn't hurt to keep your eye on the advancing and declining issues. I like to use the index watch on Thinkorswim after the open. It won't function right now because we're not open yet. These are detachable, so you can load, as many indexes as you want. You can even load your own personal watch lists, so you can make like a Mag 7 advancing versus declining tool and put those in there as well. But I like to use the S&P 100, the Nasdaq 100, and then look at issues, which is companies, versus capital. Volume's okay too. I don't mind looking at volume, but I'm really just looking for the money flow. If we have 90 names advancing, for an example, and 10 declining, I want to see the money flow doing the same thing, right? 9-1. Discrepancies show up if you have more advancing than declining, but more money going out than in. It's a bit of a warning and a red flag, and it gets my attention. So watch the advancing minus declining issues today and the money flow as we get into the open between 9:30 and 10, right? Because this is one of the few early warning tools that work that early. The tick and C-tick and weighted AD that we use, a lot of times it doesn't have any value between, say, 9:30 and 10:30, right? It needs time for the data to come in before those really start to do any good. But this thing works from the get, as soon as the bell rings, this thing is giving us really great information. The Spot Gamma Founders Note is out, so I will get that shared with you guys. These are the updated Spot Gamma levels. Somehow I ended up with that indicator in there twice. Whatever. There was a discrepancy between the SPX and the SPY. I highlighted it in the picture that I shared this morning when it comes to their collective analysis on the options dynamics. All right, so Mag 7 is leading, then Bitcoin, tech, precious metals, gold miners, China, bonds. It's a bit of a surprise. And then uranium's not up enough. We need a little bit more out of uranium, and we might not get it. It's getting a little soggy. If we get that structure to hold here off the 20, we could get a nice move in uranium back to 42, right? You see that kind of a flip off the $40 level. Hopefully we can catch it before it breaks out and get a nice run back up. Wouldn't hurt my feelings either if it can come back down. Maybe we can get in, somewhere down here. 39.50 area would be yesterday's low. That would be nice. Retest yesterday's low, maybe get a little extension through it, get some buying off of that low for this TRB. It owes us back to 42. Be careful of the mid, right? If we were to measure from this high to that low, mark the midpoint, which seems to be the open of this bar, call it $41. We could get stuck around the mid and then fail and come back in again. Right now, we're fighting the 10-day moving average from the underside, so that's not helping. But we could get a little bit of love out of the uranium. Just trying to find something that ain't so crowded, yeah? The problem is the things that ain't so crowded also have absolutely no options volume right now. It's slim pickings. Airlines are down the most in the group. We've got the year-to-date anchored VWAP down at, call it 23. It's just a little less than that, but 22 and a half-ish. So now that we're below the 10 and the 20, if we get a 10-20 cross, that's really game on. But, and it doesn't seem like that. It doesn't seem like it can't happen now. It seems inevitable that we're going to get a 10-20 cross. Aim for the year-to-date anchored VWAP, and then I would be looking for reciprocation. Whatever we got from the top of this, I would be looking to get on the bottom of that. That would be a longer-term swing trade, probably, into the end of the year. And the concern is the holiday season and whether or not they tend to get some seasonality, right? How do they do in the holiday season? September, October, November, December. Because I would hate to short the airlines into the end of the year, right into their bullish season when everybody's, traveling for the holidays or whatever. Needs work, right? To do a little bit of digging on that first. Crude is down, not much. And we've got that crude short put vertical on, and it's fine right now. It's nowhere near getting challenged because we're way down here with our put vertical, and price is way up here. It's above the anchored VWAP. It's above the 10 and the 20. It would have to break 65 to even think about challenging us. So, no concern on our vertical at all. In fact, it's probably made enough profit we could get it closed. I'll look after the stream. So gold is up, but silver is down. A little bit of a discrepancy there. Look for that to change. One or the other is going to flip. Gold is going to go down to get caught up with silver, or silver is going to go up to get caught up with gold. One of them is lying. So we got a lot of plays today. If you are a bear, you've got plenty to run short on. And if you're a bull, you've got plenty to run long on. Very clear levels to play. Nice, clean price action. You couldn't ask for a better setup today, right? So that's what I got for you guys. Be careful, be safe, make some money. I will see you all tomorrow. Where do I start the ADR? Depends on what platform you're using. I've got Thinkorswim, TradingView, and the calculations are different for both. And then it depends on if you're using the ADR for futures or if you're using it for equities and ETFs and things like that. There's no wrong way to go, right? For the ADR, the best way to do it is do it on a daily chart. Go out to the daily time frame because it eliminates all of the confusion, right? I built my own ADR just so that I know exactly what it's doing. My ADR is using a simple calculation, not an exponential calculation, and it's using the daily levels. So if you do an average daily range on a daily chart, you don't have to worry about whether it's using, today's open or yesterday's close. Now, once you get into the intraday, then you've got the issue that I've talked about with SPY and SPX versus the ES. Their ADRs won't even show up on the chart until 9:30. So I'm looking at SPY. We have no ADR lines here, none, because the market ain't open. It's going to calculate those ADR lines at 9:30 when the market does open. But for the ES, there's the ADR lines right there. And they were applied at the 6 p.m. open. 6 p.m. open. If I turn on my trading view and look at this, it would be at the 5 o'clock close is where they applied those. Confusing, right? So you just have to know, yeah, the main thing, it's not about what's right or wrong. The main thing is, what do I have? What broker do I have? And what is it doing to my code? And what do I want it to do? I like using this one that shows us from the gapped up perspective. So it applies it from where we open at 6 o'clock. But I am mindful of the fact, for an example, today's a perfect example. This high today, this 64.70, that was the ADR. That was the ADR half from the 5 o'clock close. You see that this distance is that distance. So, it's not wrong. You just have to be mindful of the limitation. And it never hurts to get the calculations. Yeah, the ADR has been hit, whether we mark the one from 5 o'clock or we mark the one from 6 o'clock. This is the ADR half right there. It's already been hit. This is the other side right here. If we hit one side early enough, we can go to the other side by the end of the day. Right now, we have a 50-point ADR. And if you split that 50 points in half, 25 one way, 25 the other way, that's your 50-point ADR. If we actually go 50 points in one direction, then we've got the full ADR. But markets don't generally do that, right? Generally, we get half one way, half the other way. ADR one half, ADR the other half. When we do move in a single shot in one direction, then it's one of those days where we just ran and ran and ran and ran in a single direction and we didn't stop. Like, oh wow, maybe this one we actually did stop, but you get the idea. It'd be one of those days where we just kept running and running and running and running in a single direction all day long. That would be hitting the full ADR. And we do it. I'm just not spotting one easily. Maybe this day. Yeah, we hit the full ADR that day. So that would be one of those days where we just ran and ran and ran all the way to an ADR, full ADR. But most of the time, price doesn't do that, right? Most of the time, we ebb and flow. No, I mean, yeah, we could, right? I just did the entire briefing. We could go to the full ADR, right? We could, of course we could. But why would we? We've already moved all this way and we hit this half ADR early in the day. And what I have found a lot is that if we've already hit the ADR half early in the day, we're going to hit the other half by the end of the day. So if we break this mid, that 64.50 that I talked about for 25 minutes, if we break that mid, that's my goal. That's where I'm looking. If we don't break that mid, then looking for a TRB back to the high and then back to this. This whole thing was recorded, so you can just go back and watch it slowly on replay, right? Kind of get a feel for it. The replay link is shared with the link that got you here, right? I share it with the Zoom every day. So you can just go back and watch it on replay. Yes, we can go to the yellow line by the end of the day. But if we break the half, we're not, right? If we break the half, I'm aiming for this lower line. All right, guys, be careful, be safe. I'll see y'all tomorrow.